Hello, everybody. Welcome to Real Vision's interviews. I'm Max Wiethe, sitting down with Dr. Bill Lazonick of the Academic Industry Research Network. As well, Bill has been an economics professor at many different academic institutions over the course of his career, and we're here today to talk about your recent book that you're publishing, Predatory Value Extraction, and to understand how stock buybacks and kind of the warping of the stock market has really disrupted what is actually driving stock gains over the past 3 to 4 decades. So thanks for coming in today, Bill.
Okay, a pleasure.
So why don't we just start out with what you do at the at this. It's a nonprofit organization which focuses mostly on economic research, if I'm not mistaken.
That's right. Yeah. So basically, I've had a career as an academic, being a professor at various universities, as you mentioned, and I set this nonprofit up, as 501c3 nonprofit up almost 10 years ago, to do research outside the university for a variety of reasons, and been working with a number of people. Now it's about 15 people who I'm working with regularly, who are in various parts of the world, who have worked with me, some for as long as 20 years, to do research on how companies become innovative, how they create products that people want to buy at prices that they are willing to pay, and can compete on national and global markets, and what happens once they actually become successful to the profits that they make. So the profits are really an outcome of some value creation process that makes these companies successful, which I can get into how that works. But basically, once they are successful, there's a huge pot of gold there in these companies. And if someone can say, that's mine, and take that money, they can become very rich. And if it's not theirs, someone's got to talk about that, and that's what I do. And so a lot of the changes that I talk about, from going from companies retaining their profits and reinvesting them in their organizations, to what I later in the 90s called downsizing the companies and distributing cash to shareholders, not just as dividends but stock buybacks. A lot of that transition took place in the 1980s when companies started articulating and imbibing this idea that companies should be run for shareholders. And I was at Harvard Business School in the mid-1980s when that ideology came in 1984. No one was talking about that at Harvard Business School. In 1986, they were. I mean, there was an easy explanation for that. In 1985, Harvard went out of its way to hire the guru of maximizing shareholder value, a guy named Michael Jensen. And I came out of economics. By that time, I had been in the Harvard economics department for over a decade and a half. I was now at Harvard Business School. I saw that, no, those aren't the people who are creating value. Shareholders are just buying and selling shares on the market. People have gone to work for these companies, often for decades. They're the ones who created the value. We as taxpayers have supported these companies with infrastructure and knowledge. We should get a decent tax rate back. And this ideology is not an ideology that's being put forward. It's being put forward as an ideology of value creation, but it's actually an ideology of value extraction. So I started researching that and learning about how that was going on, and did that within the university structure, often with collaborations and people, not just looking at the United States, but places like Japan, Korea, various countries in Europe, then got into looking closely at China, India, and trying to understand, basically, what we're talking about is capitalism, how countries get rich and what happens when they get rich, and whether there is a way in which we can explain, particularly what's gone on in the United States, of this extreme concentration of income at the top and the loss of middle-class jobs, extreme income inequality. Okay, so I started this organization outside the university for various reasons in, I think it was 2010. There is an organization that started up, which has its offices probably about a 10-minute walk from here, called the Institute for New Economic Thinking, which started up then. I've gotten through this organization, the Academic Industry Research Network, various grants from them to do research. They've been one of the main funders of the research. And I pulled together this group of people, many of them who were doing PhDs, now have academic jobs, some of them are mid-career, who we're in touch with, basically all the time. It's almost a virtual organization, but we can write about things that have been going on historically. We can write about things like let's say the Boeing crashes that have occurred more recently. We have a certain level of expertise that I don't think actually is quite unique in terms of academics and really digging critically into business and saying not just the dark side, but the bright side, and how do businesses become successful? And that's what we're mainly interested in, is how you can understand the way this central institution in our economy, the business enterprise, some which grow to be bigger than whole countries, small countries, how they actually can create value, share the value with their employees, not just because they want to share the value with employees, because it helps those employees, gives them incentives to be more productive. It's the result of them being more productive, how you get this positive dynamic going on in these companies, which we call retain and reinvest, and how we can all be better off as a result. And then critiquing a lot of what's gone on in particularly the last 30, 40 years, in people who have often very little role, if any, to play in these companies, claiming those profits are theirs. And even more, being able to lay off 5,000, 10,000 people and claim, the stock price goes up and they gain, how that can happen. And so the book that just came out this past week, which with a colleague of mine who's in Jang-Sup Shin, who is a professor of economics in Singapore. He's originally from Korea. It's called Predatory Value Extraction, as you mentioned. But the subtitle kind of summarizes the book. It's how the looting of the business corporation became the U.S. norm, and how sustainable prosperity can be restored. And by sustainable prosperity, it's a shorthand for stable and equitable growth, that we want growth that's stable employment, equitable distribution of income, which we have neither of those. And we want to get productivity growth, which can support those things. And right now we have sagging productivity growth, real problems of many U.S. companies competing in global competition, partly because of what I call the predatory value extraction, this looting of the business corporation. So that has been something that we've been doing a lot on, this group of mine, and getting a lot of visibility for that research through various outlets, because it strikes a chord with a lot of people who are saying, where is all this inequality coming from?
Well, that visibility, I came across your New Yorker profile, and I got to read about, some of the research you had done, and it really sounded like something that I felt would resonate with a lot of our viewers here at Real Vision. We've covered buybacks, and we're very interested in what's driving the stock market. And you mentioned briefly before that you're not just looking at the bad, looking at the predatory value extraction. You are also looking at what makes these companies good, and that's really how you started out your book, was looking at the theory of the innovative enterprise, as you call it. And I think that's a great place for us to start.
Well, yeah, so this, and I'll try to summarize in about 30 seconds something that's going to be another book, because there actually is a real problem if you're trained as an economist, as I was. I'm a PhD economist, got my PhD at Harvard early 1970s. Things have basically, in this regard, have gotten worse since then. Economists, generally, PhD economists, do not understand how business enterprise operates. They see the states, they see the markets, and in fact, what is being taught in introductory economics courses every year, and has been taught to millions and millions of people since a guy named Paul Samuelson wrote his introductory textbook in 1948, is, and I'm not going to get into this other than just state it, because as I stated, it'll sound totally absurd, is actually being taught that the most unproductive possible firm is the foundation of the most efficient economy. They call that perfect competition. Of course, then they say, well, that doesn't really exist. But then the whole mindset of economists is that, competition is imperfect, so we have to move through policy, through business, what business does, to make it more perfect, so that we get rid of monopolies, that we just have lots of competitors out there who are all competing the same way, producing commodities. Now, if we actually had that state of affairs, we'd be living in poverty. And so the reality is that, well, first of all, that building even a small business enterprise is in many ways a heroic feat. So I would tell students when I was teaching students, if you can start a company and can keep people productively employed, pay them a decent wage, let's say for 10 years, That must mean you have something that people is buying. Some product that people out there are buying, and you're probably going to do quite well. You're going to do quite well for you, and you're going to do quite well for the employees. But how do you get to that point that actually you can be around for 10 years? You can't do it by doing what everybody else is doing. And you can't do it just by saying, well, here what the market says you should do in terms of technology prices. You have to make an investment in learning. Now, obviously, in some companies, that we can see that on their financial statements. It's called R&D. But that's not the only type of learning that goes on. In fact, if you take the S&P 500 and you look at how many of those companies, these are among the 500 largest companies in the United States, only about 210 of those do any R&D at all. And about, I think it's something like 38 of those companies do about 75% of all the R&D. So it's, some pharma companies, aerospace companies like Boeing, companies like in technology like Apple, et cetera. Okay, but any organization, including your little organization here, people are learning how to make the product, how to do it better. And if you're going to survive, it's because you have, it might be a niche or it might be a mass production market, but you're going to be able to produce a higher quality product and you're going to get a larger market share. You're going to then cover the costs of the people, and which are often the fixed costs that you're investing in, not just the buildings, and get a competitive advantage. So that's what I basically study, how companies do that. And it's when you're talking about companies that grow to be 10,000, 20,000, 30,000, 100,000 people, you're talking about incredibly complex social organizations. And when they work well, when they're actually over a sustained period of time generating a high quality product that they can get economies of scale and get the low unit costs, even as they're paying their employees more and they're giving them employment stability, you're getting productivity growth. It has a big impact on the economy, particularly if lots of companies are doing that. And if we look at a time historically when American companies were really very good at this kind of value creation, innovative enterprise, it was a post-World War II decades, when there was much more a set of norms that prevailed, that once you hired people, you kept them employed over your career. It wasn't a contract, but it was basically, in practice, you could see it by defined benefit pensions that were non-partable, that had to do with how long you stayed with the company. You could see it at the blue-collar level with collective bargaining and sometimes enforced by unions, but this was so that you would get a labor force that showed up every day and cooperated in mass production. But you also saw it at the white-collar level without any unions. The companies trained people and they wanted to retain them. And so we had that kind of system, which actually made the U.S. the world leader in the international economy. The U.S. got challenged by that in the in the 70s and 80s by the Japanese, but the Japanese actually did that, perfected that system. Now that system doesn't work quite as well anymore in any case, because we live in a much more open system environment, much more global value chains. China's not really competing with the same thing as the Japanese system, but these way in which you understand innovative enterprise, not just at the level of the enterprise, but the whole ecosystem that supports it, is changing all the time. So we're talking about a moving target. So just that part of the research and that part of the documentation and that part of the argument, that's a real challenge for anybody who is looking at these things seriously. And we look at them seriously because we're academics.
Yeah.
And we look at seriously, at least I do, coming out of a training in economics, where I know that most economists actually don't have the slightest idea how to do the kind of research we're doing, because they think the market should just be allocating resources. And I'll just stop at this point and just by making one more comment, because one of the markets that, of course, is looked to allocate resources to alternative uses is the stock market. And the fact is that historically, the stock market, that's not been the role of the stock market in the United States. The stock market has been the way for private firms to allow their owner entrepreneurs or their venture backers, capitalist backers or private equity backers to exit from having the money tied up in the company. And you do that by going public on the stock exchange. And if the stock exchange is liquid enough, then you have no problem capitalizing your investments. And that's the main function of the stock market. The other side of that, historically, is that you can then use the stock markets to separate ownership control. You can break the link between the original owners who build up a business and the ongoing management of the business. And here I was very highly influenced by a business historian who I got to know after I had done my PhD. He was at Harvard Business School, named Alfred Chandler. Wrote a book called The Visible Hand, The Managerial Revolution in American Business, which was published in 1977, won the Pulitzer Prize in History, and really ended at 1920. It's a historical book, and said by 1920, or in the 1920s, you had people who were not the founders of business running companies. They were managers. And what made those companies strong is that those people came up through the business, through the stock market. The old owner entrepreneurs got out of the way. And now you could move up to the company, to the top of the company, being an employee, which is basically the situation today, except now some companies go public much quicker and the founders stay around. But basically, the stock market's role is really fundamentally, historically, to separate ownership control, not to fund companies. So that's one of the implications, a big implication of the research we've done.
And there was one exception that you mentioned in your book, which I thought was just too interesting not to bring up here, which is in the late 20s, where the companies that realized that the stock market had gone too far actually sold stock. And it was one of the only occurrences ever that a company had a secondary issue of stock on the market, and they had a cash surplus that they were able to weather the Great Depression with, and it actually worked. But since then, you don't see it at all.
Well, you see it, because we don't get into as much the details of some of the research we do. You see it in biotech. Certainly companies are going public on the stock market. Around where I live in Cambridge, Massachusetts, there's a lot of them. We call them productless IPOs. They do an IPO. They're a research entity. They may have some investment from big pharma. What happens there is people make lots of money in those companies even when they never produce a product. So so it's not that you can't use the stock market that way. Although, and we saw it also in the internet boom of the late 90s, the dot-coms. Often it's very speculative. If companies are sound companies, they can generally grow organically, not be exposed to the stock market until they actually have that growth secured through their own profits, and then can control their own growth because they have, as long as they can control the profits and reinvest them a significant amount, they can then leverage that with debt. And by the way, this view of the world, I won't get into this, but it also totally says throw out Modigliani Miller, because debt and equity are not substitutes. Debt is a complement to the equity that you retain in a company. But okay, now, but what you're referring to there is probably the biggest period of 28, 29, when companies actually sold shares on the market, is that all the speculators who are out there, the companies that had become dominant on the New York Stock Exchange in the 1920s now had a lot of profits. They were paying their workers better, but they were just awash with cash. They actually started lending that money out on the New York call market for 10 to 15% for people to buy their stocks on margin, speculating it up. And then they sold the shares at the higher prices and paid off their debt. The Japanese did the same thing in the 1980s. So it's kind of financial engineering, but it's actually to solidify the corporate treasury, to pay down debt, and or to just put money in the corporate treasury, which then became very useful once you get slow demand in the Great Depression. Just to say, right now we have an article that hasn't been published yet, but it's on debt finance buybacks. It's just the opposite. You're actually using debt to finance buybacks that don't. So now not only do you not have productive investment that is going to generate returns related to the buybacks, but you have debt on your books that you have to pay off. And there was actually a very good article in CNBC yesterday on Oracle and Larry Ellison and them getting into trouble. Actually, it's an article that fits everything we say about companies getting into trouble by just trying to boost their stock price through buybacks and not investing in the products of the future.
Yeah. Well, you mentioned a period of time when we did have innovative enterprise, which was that post World War II era, the decades following that. We, as America, we grew at an astronomical rate. What was different about that time that allowed that innovation to occur that we haven't seen today?
Yeah, well, so first of all, I think it was the financial sector was highly regulated. They used to talk about 363 banking. 3% was what you got if you put your money in the bank. It lent it out to its prime customers, corporations, at 6%, and the other 3 was when the time of day when the bankers went to play golf. And that's actually what prevailed into the 1970s. The 70s changed a lot, this in terms of the financial sector. In terms of the companies themselves, there was a norm that set in that once you employed people, if you just started laying those people off, you're not going to get good people to join your company. That you were building this company by investing in a lot of vertically integrated activities, and it could take decades to build the company. You would invest in research if you're a research-oriented company, not just in research and development, corporate research labs, very long-term research that could result in products in the future, but no one really knew when they were doing the research even what those products would result in. But in companies more generally, you just treated your workers better because you wanted those workers to show up every day, give the customers good service. And that became the norm. So companies that didn't do that were not companies people would want to work for. Unfortunately, that was mainly a white man's world. Even up until the Civil Rights Act, companies had marriage bars where they could tell women to leave quite legally from the company if they got married. Harvard Business School didn't admit women to the MBA until 1964 when they saw the writing on the wall with the Civil Rights Act. That's now over 50 years old, but that's not that long ago. And also what we have a book coming out on what's happened to African American employment over the last 50 years. And one of the things that happened in the 1960s and 1970s, there's still a big demand for blue-collar labor in the U.S. This is just before the Japanese impact started to occur. So there was expansion, particularly in the automobile industry, of blue-collar work. And if you could get a semi-skilled blue-collar job, that meant you were on an assembly line and you represented by union, you'd have very good pay. Well, whites were kind of the children of blue-collar whites were going to university, often free tuition or very low tuition, and moving into white-collar work. Blacks who had been, of course, in a less privileged position in the United States or a much more disadvantaged position, there was a big push, helped also by the setting up of Equal Employment Opportunity Commission to move those people up in the companies from unskilled jobs to semi-skilled jobs, and that started to work. And unfortunately, I think one of the reasons why this system was not maintained in the 1980s was because, in fact, as those jobs got challenged, I think if it had been more still a white male society, the companies there might have been more of a consensus, well, we need to retain and reinvest. And so it fed into it. Well, no, we can just why take responsibility for people we don't care about? Now, I think in the end, we can see what's happened to the white blue-collar worker now, downward mobility, lower life expectancy, opioid crisis. It hurt everybody. But I think that fed into it. So there's a lot, what I'm trying to get at here is there are a lot of social influences on what companies do and how they act and what the norms are. But those norms changed, and then they changed dramatically in the 1980s. And as I said, when I saw at Harvard Business School, that Harvard Business School went away from this notion, which they really had, of retain and reinvest. They didn't call it that, it's good to downsize and distribute. And that's what they started teaching the students, and that's what the students started getting jobs on Wall Street and being able to make a lot of money by participating in that, as if it's all about value creation. That's when things went from really changed. That's when you went from having stable and equitable growth coming out of the practice of these companies to contributing to unstable employment, inequitable incomes, and actually, in the end, in many industries, sagging productivity growth, loss of international competitiveness.
You talk about the maximizing shareholder value, but also it was coupled with changing regulations. Do you really think it was more of the changing regulations or this new economic theory, which really was the driver? Or obviously it was a combination of both, but
Yeah.
they're both major factors.
Yeah, so there was a lot of changes in the institutional environment, which are often regulatory, that fed into this. The creation of NASDAQ in 1971 out of basically the National Association of Security Dealers automated system. You had all these security dealers around the country trying to sell, small shares in small companies, and there was no national market, no liquid market. The Security and Exchange Commission in 1963 had a special study of the potential of companies being able to go public more quickly if there was a national market for more speculative companies. The impetus to that was that there were a number of companies which were called glamour stocks, which did get on the market in the late 50s and 60s, coming out of military technology that started catching people's attention, that you could use this for commercial purposes. And of course, then you had the rise of Silicon Valley. And Silicon Valley actually got named that name the same year that NASDAQ was started, 1971, where you had all these startups going and taking a lot of the technology that had been done in corporate research labs and developing, in this case, semiconductor chips, and people leaving one company to another, and then being able to get listed on the stock market. Intel, which was founded in 1968, was listed in 1971. By comparison, Hewlett-Packard, which was founded in 1938, in Silicon Valley, the heart of Silicon Valley, was really an old economy company. Right into the 90s, the HP way was you never laid people off. That's how you got innovation. They didn't go public, I think it was in 1957. I think that one of the reasons they went public in 1957 was precisely Hewlett-Packard. We're now looking at not just being the only people who control that company, brought managers up. It wasn't so much finance at that point. They were still a very careful company in terms of growth. Okay, so you started getting this market where you could put companies on the stock market much more easily. So that then meant that you could get things like the dot-com boom. You could get things like this biotech startups that I've talked about.
Then really kind of changed the reasons that people own stocks.
Yeah,
people
yeah.
stopped owning stocks for dividends.
Yeah, and then the other thing was that if you held stocks in the 1970s, you had a problem because there was inflation. And then people started saying, and also there was global competition. So there was a question, can you pay dividends? The stock market was not doing very well throughout the 1970s. So there was the change, end of fixed commissions, which was actually forced upon the New York Stock Exchange in 1975 by NASDAQ. There was, very important, was the Employee Retirement Income Security Act, ERISA, which was 1974. Now that was actually, the impetus to that was a bankruptcy, and in a particular case, Studebaker, the auto company, got bankrupt in the 60s. Their employees were left without their defined benefit pensions, so there was a movement for defined benefit pensions to have some kind of backup by the government. So that was the impetus behind ERISA. But however, you had the other side of that. How were the fund managers, in this case mainly the companies that ran the pensions, like GE's pension, how are they going to get enough yield to fund the pension when you have all this inflation? So there was lobbying, basically, to clarify under what was called the prudent man rule, which was part of ERISA, what a fund manager could invest in without being liable for, if they lost money, for being too risky. And on July 23rd, 1979, the Department of Labor, which was overseeing ERISA, clarified that you could put a certain proportion of your pension fund into risky assets like venture capital and not violate the prudent man rule and not be held liable for taking undue risk with your
other people's money. Yeah, other people.
And so from that moment, there has never been a shortage of money for venture capital in the United States. It's always been a question of what are good companies to invest in. And we always find things like the dot-com boom. It happened actually in the mid-1980s. They call it vulture capital rather than venture capital, just setting up companies just to go public and them not being worth much. you've had a lot of that going on. The problem really has not been any lack of money. So the institutions made the money flow more easily through the system. And, there's a certain amount of that you want money to be able to flow through the system, but how it flows through the system is another question. Now, on the particular issue, and what happened at that point, buybacks were not being done. So if you were a company, you were paying out dividends. The last speech by a guy named Harold Williams, who was the head of the SEC when Ronald Reagan got elected, and then he resigned. He had some time to go in as the chair of the SEC, was to security dealers. He was called the corporation as a continuing enterprise. This was in 1981. He said, corporations are paying out too much dividends. They have to reinvest more. That was before stock buybacks became a problem. Now, companies have been doing stock buybacks, which is something I spent a lot of time researching over the last decades. So here's a major regulation that actually just led to what I call the looting of the company. Companies often try to do stock buybacks. Sometimes they did it through tender offers, we're not talking about, but sometimes they just went in the open market and did repurchases. And the Securities and Exchange Commission, their lawyers there were saying, well, is that manipulation of the market? It looks like manipulation of the market to me. And so there was a rule proposed that would have tried to limit, not ban them, and they were never really illegal, but limit them. It was proposed 3 times, but never adopted. But then once the Securities and Exchange Commission changed under Reagan, they put a guy named John Shad from Wall Street as the head of the commission. He believed in Chicago economics, efficient markets. The more markets sloshing around through this system, the better off. As he still says today, capital formation. That's not capital formation. It's the money sloshing around through the system. And they adopted, really under the radar, without public comment, in November 1982, a rule called Rule 10b-18, which was totally obscure until academics had written about it, but until the research that we did, saying this is when you allowed buybacks to occur on a massive level. And we call Rule 10b-18 a license to loot. Basically, it now said you can do massive amounts of stock buybacks with a safe harbor against being charged with manipulation. Even if you exceed that safe harbor, you won't necessarily be charged with manipulation. And it turns out right to this day, the Securities and Exchange Commission doesn't know whether you're ever exceeding it because they don't collect the data on the days you do buybacks, but some people do. Okay, so then that was a regulation which basically created a whole new instrument on top of dividends, not instead of dividends, because they haven't been instead of dividends, but on top of dividends, our data shows this, to take money out of companies. And it's one that's favored by people who want to go into the company, get the stock price up, and then cash in, because if they can time the buying and selling of shares, they can make more money than they would otherwise. And in the book, we have a framework for looking at this looting, which, so it's the core of the book. After we get through the theory of innovative enterprise, a critique of shareholder value ideology, the role of the stock market, not what people think it is, we get into how is this predatory value extraction occurring. We have a framework where we talk about, one chapter is the value extracting insiders. So they're the CEOs, the top executives who are motivated by the way they're paid, stock-based pay, stock options, stock awards, which are structured in a way if the stock price goes up, you cash in. There's a long history of stock-based pay that goes back really to 1950 in the United States that we've gone through that history. I won't go into it now, but then we talk about it a bit in the book, where basically it was a capital gains tax dodge up until it was eliminated in 1976. But it really came back in the 1980s, stock-based pay, actually not because of the large corporations, but because of Silicon Valley startups that were now using stock not simply to separate ownership control, but also to pay people as a mode of compensation, and not just people at the top. They were paying people down through the organization. And actually the reason they were often paying people in stock was because they wanted to lure them away from, in the 80s and even in the 90s, from secure employment in the old economy companies.
Like the HPs and the IBMs.
Yeah, or if you think of pharma, big pharma, one of the reasons big pharma started having problems with their corporate research labs and doing really their original research in new drug development was not just shareholder value ideology, but a lot of their best people now, there was an institutional framework for startups, for products that take billions of dollars and 10, 20 years to produce. it wasn't really appropriate, but there was a way of just going to a startup, getting lots of money, making a lot of money, much more money than you can make as a research scientist, in the pharma or at Lucent or HP or IBM, et cetera. So these companies started themselves trying to change to that new model of stock-based pay. This then, at the old economy companies, often when they weren't paying stock-based pay down through the organization, this then led them to adopt that as the main way in what they were paying top executives. And then one by one, these companies changed their own internal ideology. I think later we're going to talk a little bit about Boeing. Boeing did that in 1997 when it merged with McDonnell Douglas and brought in a lot of people who were much more imbued with shareholder value ideology as a way of running a company than the existing management of Boeing. So it changed in different ways, different places. Hewlett-Packard, it lasted more of the old economy model into the late 1990s. And even though Hewlett and Packard, who had founded the companies, were no longer active in managing it in the 1990s, David Packard, I think a year before he died, published a book called The HP Way, which, sort of said, we don't fire people here. We keep them employed. We find other work for them. And then at the back of the book, he had to look at all the innovations we did over the decades with this model. So that then gave it some legitimacy until they brought in a new CEO. Her name was Carly Fiorina in 1999, and she went with the flow and turned it into a hire fire company that shareholder value oriented. Okay, so you had this change going on. That, if you hadn't had that change in the regulation at the Securities and Exchange Commission in 1982, well, you would have had to have at some point. But that's when it occurred. And what happened then is that the agency itself turned from being a regulator of the stock market, in this case, to being a promoter of the stock market. And it started being a promoter of the stock market by allowing companies to do something that was contrary to the original mandate and supposedly the current mandate of the SEC, and that is to eliminate fraud and manipulation of the stock market. So open market repurchases, I would argue, are nothing but a manipulation of the market, and they're legal. So hence the license to loot, a legalized looting of business corporation, and they're massive, which I could go into. Yeah.
Oh yeah, we'll get into that with the example of Boeing later. I think it's a fantastic example. It's really visceral, especially with what's happened recently.
Yeah.
But I wanted to get into some of the accomplices that these value extracting insiders have. You bring up two, which are the value extracting enablers and then also the value extracting outsiders. And I think both of them are equally complicit in this process. But why don't we start with the enablers?
So beyond the value extracting insiders, then the framework of the book, we then look at the enablers. So we put our money into securities to a certain extent, more increasingly not as individuals, but indirectly through pension and mutual funds. And they hold about 60 or 65% of all the stocks outstanding. Stocks still tend to be concentrated among the top 10% of income earners in the population. Not everybody holds stock, but a lot of our stock is controlled by pension funds and mutual funds. Let's say the case of pension funds. I would argue if you're running a pension fund, just from the point of view of those 2,000, 4,000 stocks or whatever you have in your portfolio, first of all, you're not going to know what's going on with those shares. You can't possibly know. But what you should want in general is a set of rules that say, okay, when companies can afford to pay dividends, they should pay dividends. And then under the rules for savings that we have, they'll accrue tax deferred until people want to make use of that money, pull the money out. If you have a pension that's accumulating through dividend payments coming into the pension. But we don't want buybacks, because buybacks are people who are timing the buying and selling of shares now. And what we want is them to pay out a reasonable amount of dividends and reinvest in the company, so that if and when we sell the shares in the company at some future date, change our portfolio, those shares are likely to be worth more rather than less. And from an individual point of view, that should be the same. If I have, $100,000 and I'm putting it in the stock market, I should put it unless I think I have some particular insights on when companies are manipulating the market. I should put it into dividend stocks, and I should look at companies that are reinvesting, and I should have a notion of what an innovative enterprise looks like, which I'm not going to get from studying economics generally, but from understanding, in fact, historically how businesses become successful, and put it into those companies. And now, we could make mistakes, but I would say if you had a portfolio of those shares, you would do better. Now, of course, one of the reasons we don't do it ourselves is because we can get diversification and the expertise, et cetera, from the fund managers. But that's how fund managers should be behaving. But in fact, what turns them into enablers is the fact that they're being judged by the yields that they can get. In here you can say quarter to quarter. I don't think everything is quarter to quarter, but it often is in this world. And that if someone else is getting a higher yield and you're not getting it, you might not be the fund manager for long. So everybody is looking to get those higher yields. So they start trying to figure out, well, where are the companies that are going to get this price boost? And they stop thinking or even trying to understand. And of course, depending, because of the way they're trained, not just now in economics department, but particularly business schools, they're just going to be thinking about how you diversify, get a high yield, et cetera. They'll just go with the flow. So they become enablers. Now, here's again regulation that made them more powerful enablers is that in the 1980s, there was a movement in the name of shareholder democracy for shareholders to not only have votes, but exercise more power in companies. Now, on some level, you might think that's a good idea, but if shareholders are just people who buy and sell shares, it's not such a good idea from my point of view. And in fact, at the time, the push really came not because more and more people were holding shares, but because shareholding was becoming concentrated among a few big asset managers, which has become quite extreme now. You then have the question, well, what do those asset managers do with the proxy votes of those shares? Now, an argument can be made that they're just holding the shares for you. Why should they get to vote the shares? Well, it was ruled basically, yeah, they get to vote the shares. But in 2003, the SEC sanctioned a rule that says not only do they vote the shares, they have to vote the shares. Yeah. And that gave rise to two companies. One existed, ISS, Institute of Shareholder Services, another Glass Lewis, that divide up the market in proxy advising and have very small number of people working for them and advising on massive numbers of proxy votes and shareholder proposals. And so they then became part of a system where if you could get them to advise in a particular way, then you could actually, with a very small percentage of the shares of a company, have an outsized influence on the shares. And that's where the outsiders come in. And they're the shareholder activists. I mean, the one we write about in the book is Carl Icahn, who's been around since the late 1970s. People like Paul Singer, Nelson Peltz, William Ackman. There's about a dozen of them. And I wouldn't say in every case they go in and do damage. There are a few of them who try to get into companies and cooperate with the companies in investing for the future. But in general, the way they're going to make their money is by getting them to pump the money out of the company and figure out when to sell their shares. And it doesn't mean they're going to hold it just for a month or two. They might hold it, as we show with the case of Icahn and Apple, for 30 months and took out $2 billion and $3.6 billion in just buying shares on the market. But in that period of time, Apple did the highest amounts of buybacks of any company in history, and this was 2014, 2015. Well, Icahn was holding the shares, $45 billion 1 year, $36 billion the next year. Apple actually has far outstripped that since then, but that was a game changer, because now you take an iconic company that actually we documented and stuff we wrote when Apple had previously gone to this kind of shareholder value mode, which was between 1985 and 1997 when Steve Jobs wasn't there. They almost drove themselves into bankruptcy. Jobs came back. It was retain and reinvest. We know the story. Now they have lots of money. He died. Tim Cook became the CEO. And since 2013, they've done $288 billion in buybacks. And just in case anybody thought that Warren Buffett, who built up Berkshire Hathaway by protecting all those companies from the stock market as a patient capitalist, well, he's not. he's now is the biggest, by far bigger, about 10 times the stake that Icahn has, and he's just a rabid cheerleader for stock buybacks to increase his stake. And what that means is you're not going to replace an Apple. It means that Apple is not taking money. It's $288 billion just in buybacks since 2013, and investing in the Teslas and other companies of the future that it could be investing. And this is even with someone like Al Gore on the board, one of the longest standing board members since 2003, who is, of course, we all know him not just as the former vice president, but one of the main advocates for climate change. What could Apple have done with $288 billion in saying, we have a company that can hire the best people, that has an iconic brand name, that can compete globally, can move into new technologies, if it had gone into green technology, if it had gone in that direction, which it could have. It hasn't. So that's a lost opportunity. And you don't just recreate those companies to be in that position, to have all this money, to have the ability to attract people, all that learning that's available. So that's, okay, so we then get to these outsiders who have become much more powerful, and were made much more powerful by this rule in 2003, this proxy voting system, where you can hold a tiny fraction of the shares, still a couple $2 billion maybe, of a company like Nelson Peltz at GE with never more than 0.8 of the shares, but get that company to just pump all kinds of money out of the company for the sake of shareholder value, and cease to have any potential to be the innovative company. And in the case of GE, we rely on GE as the U.S. as it's the main, really the big company in wind energy. So what damage does that do to its ability to compete? Actually, it's losing markets even in the United States to a Danish company, Vestas. So that's the kind of thing we look at, and we see it again and again. But we see that there's now this whole configuration of the insiders, the enablers, the outsiders, all focused on getting stock price up. And buybacks are the tool in which they do that. And we're saying, hey, let's stop letting them do this. Let's change the rules so that we have a system that doesn't allow this predatory value extraction, allows this value creation, sharing the gains with the employees, paying us as taxpayers who help support this through infrastructure and knowledge, a decent tax rate so we can not only get a return on that, but invest in the next round of innovation without the government going more into debt to support the companies in innovation. So that's the model we have, and it's not the model, well, that's the model we put forward, but it's not the model we have. We have this model which is really deeply entrenched now in what we call predatory value extraction.
Well, and I thought also a really interesting transition you did was from Carl Icahn as sort of the corporate raider, where he's taking 25% stakes, and now he only has to take less than 1% stake. And people would suppose maybe that's because they're afraid of him becoming the corporate raider, but really all the incentives are aligned. He doesn't have to. It's really that he doesn't have to, so not that they're afraid.
Yeah. So it was because of him that the term green mail got coined. It actually only, we looked at it, it only got started used around 1982, 83, and he went after a number of relatively small companies that were locally based, and he started getting control or threatening control. And all he had to do was threaten, and then they would buy him out, green mail. And so they were doing that even before it got termed green mail. What you find, we've looked at a few of these cases, is that within those companies, there were some people, there was actually, should we try to fight them off? Should we let them in? There are some people who said, no, okay, let's do this. We'll get our stock price up. And often they had their own stock. So you start getting this aligning. But sometimes, it was called hostile takeovers at the time, because often it was seen as hostile. The people who were running the company did not want these outsiders. Now, you could always say, well, they're incumbent, they're just protect their own interests. It could be that those companies are not being run properly, but it's not going to help to have someone come in whose only purpose is to get the stock price up, and using the ideology of shareholder value as to legitimize this. You have to understand the principles of innovative enterprise. And I think good executives do understand that. The only one case that occurred relatively recently, which everybody probably knows about, is Whole Foods. So Whole Foods was known as, of course, now owned by Amazon, but known as being a really good employer, charging high prices, but it was getting,
People are buying it still.
yeah, people going there, shopping there. And in the fall of 2015, I was asked actually by someone in one of the presidential, Democratic presidential, Bernie Sanders campaign actually, someone asked me, why is Whole Foods, because I've been saying Sanders should talk about buybacks, why is Whole Foods, they'd done about $1 billion of buybacks. Why did they do that? I looked at it and I saw that, in fact, in September of 2015, Whole Foods had laid off about 7% of its labor force, about 1,400 people. And the stated purpose was that so they could charge somewhat lower prices to compete with Trader Joe's other premium brand. So I thought immediately, well, okay, that means the other 93% of the people are going to have to work harder. And I then did a calculation of what they did in terms of buybacks per laid-off employee. It turned out to $727,000 per employee. So if they hadn't done the buybacks, they could have kept those people employed, with their benefits, even if they're $60,000, which is probably high. They could have kept those people employed, and they would have had plenty of money to lower prices. And they wouldn't have forced people to work harder, who were the remaining people. That would have been a much more rational thing to do. The reason they didn't do that was because they were being attacked by hedge funds. Now, when just before or just after they sold to Whole Foods, the CEO of Whole Foods was on the record of saying, and it's one of the few times I've ever seen this, calling those activists a bunch of bastards, a bunch of, hardly anybody will speak out against him. He actually did. But the reason he sold to Amazon, which is what they used to call a white knight. It was someone there who could at least protect the company.
Yeah.
And there was a logic in their business model. We see that going on still to some extent. Now, the other thing that changed with someone like Carl Icahn, so although he was making lots of money, he actually, when he ended up having to run TWA because the green mail didn't work, and he lost a lot of money in that. So the notion is you get in, you get out. The other thing that changed is as he became wealthier, he didn't have to rely on other people's money. So in 2011, Icahn Enterprises just his own money basically, and that gives him even more power because he doesn't need to keep his own investors aligned with the rate or whatever he's doing. And he always, right from the late 70s, when he started doing this, called this money his war chest.
Yeah.
So the more he has, the more value extract, the more of a war chest he has, the more power he has. I think the other thing that's going on is that on the boards of companies, first of all, I think there are a lot of people who just believe in shareholder value. A lot of people on boards who don't have the slightest idea of what those companies are really doing in many cases. And so you often can, without a proxy fight, just influence people on the board to say, yeah, back doing more buybacks, back, pumping more money out, back things that are, do a merger or do an acquisition, but do the acquisition so we can get control of the money in that company and pump the money out, rather than do the acquisition so we can spend a lot of money to build that company up. And you don't really know what's going on. Another very important point is like I can talk about an era back then, when it was more retain and reinvest. That's still going on in some companies now. I think this conflict is still going on now. So we talk about a tension between innovation and financialization, and you don't really know how it's being played out until you look at these companies. But there's much more forces are aligned for it being played out on the financialization side than on the innovation side.
So we touched on a few examples of places where stock buybacks and insiders, outsiders, enablers have allowed predatory value extraction to take over the place of reinvest and innovation. But I think one of the best examples right now that you can see, because it's one thing to say the company isn't innovating anymore or they're not making as much money as they could be, but Boeing, people are are actually dying because of this process of the financialization of what was really an engineering company for so long. And I actually, in a conversation with my father, he said they kicked the engineers out of the boardroom.
Yeah.
You brought it up earlier. I think it was 1997. They had
Yeah.
that merger with what was the company?
McDonnell Douglas.
McDonnell Douglas, and I think really just starting with that and moving forward, what happened at Boeing and how did we get where we are today?
Yeah. So, first Boeing was founded in 1916. It was a beneficiary of a lot of government subsidy, including a couple of acts from the Postmaster General Office in 1925, 1930 that created subsidies for airlines to buy more advanced planes. I've written about this, and Boeing emerged along with Douglas as the innovators in integrated wing, all metal fuselage planes in the depths of the Depression between 1930 and 1932. And actually, Douglas ended up doing better as a commercial company in the 1930s and beyond. Boeing was much more oriented toward the military side. But Boeing then, with the jumbo jets, was able to emerge as a stronger company. There was Lockheed, there was a few other companies, and was able to then consolidate as the main, really the only big aircraft manufacturer in 1997 when it acquired McDonnell Douglas. And at that point, you had Airbus, which had been created from a consortium of European companies to be a competitor to Boeing, which was rising as a competitor. It's well documented that there were a lot of financially oriented people who came into Boeing with the merger. Some of them had come from General Electric, and they started pushing shareholder value. That year, actually 1997, significant in two other ways. That was the year in which the Business Roundtable declared that shareholder value would be the primary purpose of companies. This is an organization of which CEOs are members of major companies. And as people might know, recently, this few months ago, they changed the tune on that. They said now we're run for stakeholders. But Boeing at that point actually turned to being a shareholder value company. The other thing that happened in 1997, it was the first year that buybacks surpassed dividends in the form of distribution to shareholders. And you had the stock market boom going on, and many companies trying to keep up with companies that had high-flying stocks by doing buybacks. So let's say Cisco, which ended up having the highest market capitalization in the world in 2000, March of 2000, didn't do buybacks. But other companies tried to keep up, like Microsoft and Intel, by doing lots of buybacks. So this was increasing. Now at Boeing, by 2001, the top executives said, we don't want to be too close to the engineers here in Seattle, which was the original birthplace of Boeing, and they've been since 1916. So they moved their headquarters to Chicago specifically to be away from the engineers. Said, okay, you can do the engineering. Okay. Now you started having, what's their business? Their business is producing major aircraft, the large aircraft, and they're, at time, there still is the case. There are two companies capable of doing it. The Chinese are on the horizon, maybe the Japanese in the future. They needed a new long-haul plane. They needed a new mid-range plane. And partly it was because of advanced materials, avionics, and fuel-efficient engines. So they built the Dreamliner, which was what they call a clean sheet, it was a wholly new plane, really. It wasn't even a replacement. It was just a new plane, and they had a number of problems with that in terms of the outsourcing of stuff. They were doing a lot of outsourcing of the capabilities, but they were doing that from the early 2000s. And then they knew they had to have a replacement for the 737 NG, and the 737 series was a single-aisle, narrow-body plane for mid-range flights, which they called the workhorse. So this is the one that would often be the biggest selling plane, and it would be one where they would be used for a lot of longer domestic flights, some shorter international flights. And they had this architecture from the 1960s for the 737. It had been re-engined, I think, 2 or 3 times. The last one was 1993, which was called the 7NG. Re-engine just means they kept the same architecture and put a new engine on it. And already with the NG, which meant new generation, which was a big selling plane, and their main competitor is the product in terms of these narrow-body mid-range plane. They had a problem because of the wing being too close to the ground, which Airbus did not have because their series, the 320, originated in the 1980s when you were using the loading equipment and you built the wing higher up from the ground, so you could put more of an engine, a bigger engine underneath. The fact is that the bigger the engine, the higher the fan diameter, the higher the longer the fan diameter, the higher the bypass ratio, the more fuel efficiency. Generally, other things equal. So this had already become a problem with the NG. It's actually doesn't have a purely round shape. It's kind of flat at the bottom to give a bit of extra space between the wing and the tarmac. The fact is, when they were thinking of what to do in the probably about 2003, 2004, 2005, they actually had a project called the Yellowstone Project 1 to think about what they were going to do to replace the 737NG. What they should have done, there's no doubt in my mind, what they should have done is done what they call this clean sheet replacement. And they would have been able to take advantage of all the modern avionics, all the modern materials, and have plenty of space for the most fuel-efficient engine. That was on the books. Apparently it was still a possibility even up until the spring of 2000 or summer of 2011 when they announced that they would do a re-engine plane, the 737 MAX. They did that also in reaction to the fact that in December of 2010, Airbus had put out the 320neo using their company CFM, which is a joint venture between GE and Safran, a French company, LEAP engines, which were much more fuel efficient. And actually the fan diameter on the LEAP engines that Airbus uses are 78 inches. So now this was a problem for Boeing because they already had reached the limits. So there was then a debate at Boeing, which I've been able to find a little information about, of how big those engines could be. There was never even an issue that they could possibly be 78 inches. So it was a question, on the NG, they had been 61 inches, the fan diameter. They said maybe up to 68 inches. In the end, they put some extra height on the front landing gear, and they got it up to, first supposed to be 68 inches, actually 69 inches, so they reached the limit. If they hadn't done that, they would have been subject to a critique, as they were, in fact, quite vocal from Airbus, is that you weren't going to get the fuel efficiency on the MAX to compete with the Neo. And so that would have been a big problem. So they were trying to figure out how to get these fuel-efficient engines on there, given an architecture where you had to reposition them more forward, more upward. Okay, now here's something where a lot of people have opinions, but the investigations really haven't been done to really say what's going on, and that is that the opinion, there seemed to be widespread opinion, that repositioning of the engines and created a tendency of the nose to pitch up during takeoff when it's on manual before you get up to your cruising speed, and if it went picked up too much, the plane could enter a stall, and so you want to get back to a safe, what they call angle of attack. And this is something that the pilots, would be aware of and would be looking at readings from two sensors that are on the exterior of the fuselage. If they agree, then they just see what the angle of attack is. If they disagree, they would get a light that was on the NG and say disagree, and then they would just shut the system off. They would just figure out how to get the angle of attack. They would
fly manual.
Yeah, but what was happening here was that they put on a system which later became known as MCAS, Maneuvering Characteristics Augmentation System, that was doing this for them, and they didn't even know about it until after the Lion Air crash, which happened in October of 2018. So the timeline is the planes launched in 2011. The end of 2012, they have 2,500 orders. Just before the second crash of the Ethiopian Airlines plane, that was in March 10th of this year, 2019, They had just over 5,000 orders, 387 delivered. The plane had been certified in March of 2017, the first delivery in 2018. Now, a year and a half later, you have this crash. And it immediately is, well, suspected that it was a faulty sensor. And then Boeing was forced to reveal when it was American Airlines pilots went after them, what's going on here, that they had this MCAS system on there. They didn't even call it that at first, but then it became known as that. And they hadn't put it into the flight manuals, and there's all kinds of issues that have been written about whether they let the FAA, the Federal Aviation Administration, know about the system or know how more powerful the system had become. There's a whole lot of issues of concealment that are there and still being investigated in Congress, and an issue right now because as of today, what's today, December 6th, 2019, those planes have not flown since last March 13th, none around the world, and nobody knows when they're going to fly. The issue is, are they going to fly? I wouldn't know whether I should bet on this because I don't bet, but I'd say the odds are, in my view, that they won't ever fly again. And that would be true if they have this structural defect. And there's been more evidence that there is this defect, that it's not just a software fix and it's going to deal with it. It's not a software fix that now pilots know about and they train them. If it was, you would think the plane would be up in the air again. The other thing is, you would think that Boeing would have come and rebutted the notion that it had this structural design flaw, because obviously that's out there. Everybody's talking about it. You just see on the chats and on any article, people say, well, it has a structural design flaw. You know, if that's not the case, come out and say, no, that's not the case. Now, obviously, here to get to the crux of it, if they had built a plane they never should have built back in, when they had the choice in 2011, when they launched the MAX, and they could have gone to the clean sheet replacement. By some estimates, it would have cost them $7 billion more, maybe $8 billion more to do that rather than the re-engined plane. It might have taken a year or two longer, but this was one of the greatest engineering companies in the world. And there was every reason to do it in terms of material, avionics, fuel efficiency, the planes. And they actually still have it on their books that they're going to do it, that they should have done it then. They didn't. Okay. And why didn't they do it? Well, we don't know for sure. We have some possibilities. We do know that Southwest Airlines, which was the biggest purchaser of 737 planes, wanted a plane that would fly just like its previous plane, so it didn't have to retrain the pilots. So the pilots were in an airport. They were going from an NG to a MAX that would be not going to a different type of plane. Okay, that might have been part of it, but they could have paid the $1 million per pilot to retrain them, or give them a disc. They could have figured that out financially. It may be, this is more speculative, that they already are having problems with the Dreamliner, with all the outsourcing they had done, which was part of their business model, and they didn't want to start that whole process anew at the same time with the mid-range plane. So that's possible. And then there's also the possibility, that's where the financialization comes in, but it's not the only reason. The fact is, the period when they should have been thinking, how do we mobilize all our resources to build the planes of the future, between 2004 and 2011, and on top of paying very ample dividends, they paid $11 billion out in buybacks. And so when you come to 2011, most companies stopped doing buybacks, a lot of them in 2009 in particular, at the financial crisis, were a little reticent in 2010.
When you actually should have done them.
Yeah.
If you ever actually should have.
Yeah, they were always buying stock when the high prices, and but that money would have come in handy, that money plus interest, that if they had it. We don't know the reason. I think there really should be an investigation into why they didn't build the clean sheet replacement at that point. Once they went the route of the re-engined plane, if it's true, and this we don't really know, but there are congressional investigations that could find out that this plane had a design flaw that made it inherently unsafe, and they didn't want their customers to know about this, so they tried to fix it with the MCAS, and they didn't tell any about it. Well, that's pretty serious. Now, where does financialization come in beyond that? they didn't do much in the way of buybacks. They didn't do buybacks between up through 2012. But in 2013, right at the beginning of 2013, they started doing them. By that time, it was clear that in terms of sales, that the MAX was a success. It's the fastest selling plane they've had in history. I think the NG might have sold more than they've sold so far, but in any case, the fastest selling plane, and this looked pretty good. And I mean, Airbus was doing very well with its plane, so it wasn't just that it was huge demand for planes, which also, particularly Lion Air is one of the biggest purchasers. It means that you're also getting a huge demand for pilots. You're not going to have every pilot being trained as a military pilot, So we need planes we need competent people being pilots, but when we get on a plane, we can't assume that Sully is on there, Sullenberger, Any case, at that point, we don't really know what they knew or they didn't know, but we do know that they started propping up their stock price. And so between January of 2013 and the week before the Ethiopian air crash, they did $43 billion in buybacks, including about a little over $9 billion in 2017, $9 billion in 2018. Less than 2 months after the Lion Air crash, they increased the dividend by 20%. They authorized a new $20 billion buyback program. If it hadn't been for the Ethiopian air crash in March, they probably would still be, doing buybacks and, hoping another plane didn't crash. We're not sure, but I would have said, they probably would have done $12 billion this year or something like that. March 1st, 2019, which is when the new dividend went into effect, they hit their all-time peak in stock price. The Ethiopian airplane crashed 10 days later. Okay, now here's the thing, that this might have occurred even if they hadn't been focused on their stock price. You might have had, I use the example of Volkswagen with the diesel emissions, not a particularly financialized company coming out of Germany. But if you're at the top of the company and you're trying to meet regulations and you can fake the data and you can sell your cars, there might be some executives who are tempted to do that. And actually, I think there's some in jail now because of that.
Yeah.
So it's not that it's only going to happen in a company where you have all these buybacks going on and you're focused on your stock price. But it certainly supercharges the incentive to do this. And if the public is buying into the notion that a high stock price means the company is doing fine, then it creates a certain aura of success of the company. That it's got its high stock price, it must be okay. So even the frightening thing is that even after the Lion Air crash, when they knew that this may have been, they started discovering why this may have occurred, there was still an attempt by Boeing to blame it on the pilots, to say that one particular plane was not airworthy, and they doubled down, in a sense, on trying to get their stock price up. Meanwhile, the executives are doing very well in this. The McNerney, who had been the CEO from 2005 to 2015, I think we had something like $257 million went into his pocket as actual pay. A large percent of it of its stock based and other related to higher profits, which of course come from having all the orders for the plane. For Muhlenberg, the current CEO, who's then now stepped down as chairman, but he was between 2015, summer 2015, when he became CEO, and the end of 18, for which you have the data, it was about $2 million a month flowing into his pocket. Now, that's a lot of money, even if you are successful in producing a safe plane, because it's really the engineers, the whole. Yeah. But if, in fact, you're not doing what you basically should do, is produce a safe plane, then it's a big problem. Now, the last thing I'll say about this is that a lot of and we have this in an article in American Prospect Group published last May, which talks about this. A lot of the notion, the ideology behind shareholder value is traced back to an article by Milton Friedman, a well-known conservative economist from Chicago School, in 1970 in the New York Times magazine, where he said the only social responsibility of a company increases profits. This was actually came out in direct response to Naderism and Ralph Nader and the push for more fuel-efficient and safer cars. And in fact, the context was that there something called Campaign GM that wanted to put 3 public interest people on the board of General Motors to push for more fuel-efficient and safer cars. Friedman published his article, it was solicited by an editor at the New York Times, and called this, and it was repeated in some editorializing at the beginning of the article by the editor, pure and unadulterated socialism. Okay, just to be put, now we know the future of the auto industry.
Yes.
They should have had people on there who were pushing for producing safer and more fuel-efficient cars, because that's what won out in the auto industry. And so the only social responsibility of a company is, you could say, is to produce fuel-efficient, safe cars. In fact, it's not a social responsibility. It's an innovative strategy. So he was basically telling people, saying that it's pure and unadulterated socialism, don't be an innovative company. So it comes full circle back to what the start of the book is, about what a value-creating company is, what innovation is, where it comes from. It doesn't come from saying we're going to increase our profits. It comes from producing a high-quality product that people want, in this case, fuel-efficient cars, safe cars, in the case of Boeing plane, first and foremost, obviously a safe plane, and then getting a large market share to spread out the fixed costs and get economies of scale and make it more affordable. And that's where we get productivity growth. That's where we get a basis for paying people higher wages, paying higher taxes. That's where we get the positive sum scenario in the economy as a whole. And so Milton Friedman's article was really putting the cart before the horse. I mean, saying, you want the profits? No, if you want the profits, produce the product that the market needs.
They actually want.
Yeah.
Well, I think you make a very strong case, and I was hoping today we'd be able to get into your last 5 points. I don't think we have the time, so we'll leave it to everybody. If you want to hear, Bill does lay out, he doesn't just lay out the problem, he also does give 5 points as to what he thinks will be the way to fix this problem of the lack of innovation in major corporations in America, but also across the globe. So Bill, I just want to say thank you for coming in today. It was really fascinating.
Yeah, my pleasure. Thanks.